Hello, I'm Scott Christensen with the Alliance Group, and I want to talk with you today about taxes. If I were to ask you, do you think taxes in the future are going to be higher or lower? What would you say? Well, the vast majority of people do believe that taxes in the future are going to be higher. The question is, how much higher? And so we asked the question as a follow up, what is the highest marginal tax bracket that this country has ever had? And most people have no idea. And in fact, some people don't understand or know what a marginal tax bracket is. And so just to define that, a marginal tax bracket is the amount of tax that you pay above a certain income threshold. So currently, on the first $20,000 approximately that you earn in this country of taxable income, you would pay a 10% tax. On the next $60,000 of income, you would pay a 12% tax. And then on the next $90,000 of income, you would pay a 22% tax. So those are marginal tax brackets. As you increase your income, you pay a higher percentage of tax on that increase in income. So when we ask the question, what is the highest marginal tax bracket that this country's ever had? Most people say somewhere between 40 and 50%. And unfortunately, that is significantly low. Would it surprise you to know that the highest marginal tax bracket this country's ever had was 94%? That's right, 94%. Now, again, that was a marginal tax bracket. That didn't mean that if you made $10,000, you had to send $9,400 into the federal government. What it meant that at some level, once you earned a certain amount of money, everything above that was taxed at 94%. So you literally had no incentive to work. If you lived in a state that had a state tax, say of 6 or 7%, if it was 6%, you basically gave up 100% of all your income over a certain threshold. So we have to understand how taxation, what drives a government to change its marginal tax brackets. And so we're going to go back in history to 1913 when the current tax code was enacted. And that at that time, the top marginal tax bracket was 7%. That's right, just 7%. And we held at that level for about 4 years. And then in about 1918, it shot up, and literally, when I say shot up, it shot up to over 70%. Now, what would cause a government that had just enacted a taxation system to 10 times their top marginal tax bracket? Well, if you think back in history, our country had entered into World War I. And when governments need money, they increase taxes. So they increased the tax so they could create more revenue for the government for the war effort. Now, those top tax brackets stayed in place for about 4 years, and then they dropped down to about 25% being the top marginal tax bracket, and stayed there through part of the 20s, and towards the late 20s, early 30s, the rate shot up again. Now, again, if you think about history, what's happening in this country in 1929, 30, 31? That's right, it's the Great Depression. And tax brackets shot up above 70% at that point in time again. But what would cause our country to go to the 94% tax bracket? Well, that event is World War II. And in 1942, on any income above $5 million, you had to pay a 94% federal income tax. Now, granted, in 1942, there weren't a lot of people making $5 million, so it didn't have a significant impact. So because it didn't raise enough revenue, the next year, Congress reduced the amount from 5 million down to 200,000. Now it got people's attention, and there were a lot more people impacted. One other thing about that period of time, from the 40s, the 50s, the 60s, the 70s, there were actually a lot of tax deductions. There were a lot of ways to reduce your income. And as a result, people didn't have to pay high taxes unless they were earning just significantly large amounts of money. Then in the 80s, we had President Reagan reduce tax rates down to the top marginal tax bracket in the early 80s, 80, 81, was about 28%. Now, in order to do that and make it work, he had to take away some deductions. Two of those deductions were the ability to deduct the interest that you paid on credit cards and the interest that you paid on car loans. So when government officials talk about, not taxing, not raising taxes, the problem is that they can't foresee events in the future, such as wars, depressions, other economic calamities, such as the pandemic that we're currently involved in. They can't foresee those. And so as a result of that, they can't predict with any degree of accuracy what the future events are going to require in terms of tax revenue. And as of the making of this particular video in March of 2021, we currently have a national debt of $26 trillion. And they're looking to add another 2 or 3 or 4 trillion to that sometime over the next year if they possibly can. Now, here's the question. Who's going to pay that money back? How's the government going to pay that money back? Because they borrowed the money from the Federal Reserve. The Federal Reserve essentially printed the money and took back treasury notes in collateral or other types of collateral. So there's interest on this loan, this $26 trillion. How are they going to pay it back? Folks, they have no choice but to increase taxes. We just don't, it's not a question of if they will, it's a question of how much and how badly it will affect everybody. This idea of only the rich will be taxed, talking about increasing taxes on those making over $400,000. Well, that's all well and good. And maybe those making more than $400,000 need to pay more in taxes. But what I do know is that there's also a trickle-down effect, meaning one way or another, those higher taxes are going to have an impact on you and I. Because there's some other taxes that don't have anything to do with the federal government. And those taxes are taxes by states, municipalities, cities, and so forth. For example, there are some states right now that don't have an income tax. I think Texas and Florida being two of those states. They have very high property taxes. Okay? So the federal government can look to the Federal Reserve to borrow money, but the states have to look to the federal government to borrow money. They can't print money. They don't have access to the Federal Reserve. And as a result of that, the states are going to have to look elsewhere to raise revenue. And we're seeing it beginning to happen. We're seeing property taxes beginning to increase. We're seeing sales tax beginning to increase. There's a myriad of taxes that are going to be increased. There's going to be some new taxes. We've heard of cities implementing streaming video taxes and other types of taxes like that are in their control that they can increase without a vote, so to speak, without your permission. They're just going to do it. Okay. So one of the things that we want to teach our clients is how to position your current assets and your future assets so that they are taxed at the lowest level possible now and in the future. And most of the things that we're being taught to do are exactly the opposite. I'll give you a prime example. We're currently being encouraged to put money into our 401ks. Now, I do want people to save for retirement. That's a great thing. But we're being encouraged to put the money in pre-tax, have it grow tax deferred, and then pull it out when we retire. At that point in time, it would be taxable. Now, most people think they're going to be in a lower tax bracket. But do you know for sure? What about the other side of the coin? What if you chose to put it into your 401k in the Roth provision? And some 401ks have that provision where the money goes in after tax it grows tax deferred, and then can be accessed completely free of taxes in the future. So we help our clients understand whether they should be in a Roth 401k or a traditional 401k. Should they convert their old IRAs, their old 401ks into Roths, or should they do something different? Now, we have a whole process that we go through, and we'd love to have the opportunity to visit with you and talk with you about your personal circumstances and how we might help you identify the tax savings that are available to you and position your assets so in the future they are not going to be subject to significant amounts of taxation. So a couple of things we'd like you to do. First off is if you like the information that's being shared here, click on the subscribe button so you get more of our videos. We're putting them out on a regular basis. And also there's another link that we'd like you to click on, and that is the educational series that we've created. We're trying to help people understand that there is a significant change in the economic environment that we're living into, that there needs to be a significant shift in how we think about our future and how we plan for the future, because we're in a new economic paradigm, a new financial paradigm that requires an entirely new way of thinking. And so we've got an educational series that will help you get a better idea of some of the things that we teach our clients that will put them in a position to thrive in the economic future we're living into, as opposed to causing them to arrive down the road economically and find out that they've made mistakes, things that they could have taken care of many, many years ago. So we look forward to talking with you again, and thanks for watching today.